Hi, welcome to T Minus Retirement, podcast where we help launch your retirement into orbit. I'm Jay Cole,
And I'm Dustin Watts.
and in this video, we're starting to get a lot of calls from clients just asking how the big beautiful bill will affect them tax wise, and so we figured it'd be best just to highlight some of these new tax changes and see how that's going to affect people overall. One caveat on this is all out of all the changes that we're going to list, I believe only one of them is going to take into effect in 2026 for that tax year going forward. So we'll note that more in detail. But the rest of these should be applied to 2025 year and going on. But yeah, we just wanted to see how big and how beautiful these changes could be when it comes to your taxes.
So Jay, before we get into like the nitty gritty, how do you think it's going to really impact the majority like of your tax clients? Are people going to see a huge savings, or do you think it's going to be relatively similar to last year with a couple caveats?
That's a good question. I think some of these changes are really going to benefit more middle class to higher class income earners. One of the biggest changes we'll talk in a minute is the increase the SALT deduction. I think overall it's going to affect the majority of my clients. It's just there's changes all across the board. It's not like it's just changes applied to one specific set of people and the rest aren't going to benefit from that. So it is going to change. It is going to help, I believe, a lot of people. There are some income thresholds when it comes to some of these changes and some of these new deductions, but I do think overall it's going to be beneficial to the majority of people.
That's good to know because really it's the tax rates are the same, right? But
Right.
it's more of you can write off some additional things, some standard deductions are a little higher, things like that, that overall clients might get, a little bit more of a tax relief benefit from.
Correct. Yeah,
Okay.
that is correct. So yeah, the tax rates still stay the same. I mean, they're indexed for inflation, so it's going to be, the brackets are going to be a little bit different from the current tax year from 2024. But
Right.
yeah, essentially the tax brackets are relatively the same, and they're just adding some additional deductions now.
Okay.
Yeah. So kind of starting off here, I mentioned earlier the SALT deduction has been increased. So what that is the state and local tax deduction. So for anyone that itemizes, part of what's included in their itemizing is what they pay in property taxes, what they pay in like car registration fees or boat or RV registration fees, and then also what they pay in state taxes and even city taxes as well. So that's all incorporated within that SALT. Now, for the past, let's just say 8 years or so, that's been capped at 10,000. Meaning, if we add up all of those taxes that you've paid, and if it's over 10,000, well, we're capped at 10,000. That's it. They've now increased that 4 times to 40,000. So the benefit I'm going to see is going to be people in more higher tax states. So, like here in California, they're going to be able to utilize more of what they pay in property taxes and just in state taxes in general. Whereas in the past, that was always capped at 10,000. So I think that's going to be a huge benefit to people either paying a lot in state taxes or if their property taxes are high as well.
Yeah, I know that's going to be a huge increase for people because, as you mentioned, Jay, over the last couple of years, that was such a kind of sticky topic when doing taxes because you could have your property taxes be more than that threshold limit, so you can't even write off all your property tax or let alone your state tax, DMV fees, anything like that. So, one thing you said is that's if you itemize. So what did the standard deductions go up to? Because for you to take advantage of some of these items, like the SALT deduction, you have to itemize your return, which means you have to have write-offs over and above what the standard deduction is. If I'm remembering correctly, I want to say married filing joint, the standard deduction went up to 30,000, was it?
For 2025, it's 31,500.
Okay. Okay.
Yeah. And that's for a married couple. For a single couple, it's a little over 15,000. I forget the specific number at the moment, but 15,750.
Okay. So
So
yeah, you
so
have to have write-offs over and above that standard for you to benefit from this. But if you're in that situation where you have high property taxes and state tax, then you probably will be able to take advantage of that.
correct. Yeah. So I think that's going to be a huge benefit to a lot of people, and especially people buying newer homes now in areas
Yeah.
that have appreciated so much. Like where we live, we have a interesting mixture of clients where they've owned the same house for almost 30 years and their property taxes are pretty much nothing. And then you have clients that are buying brand new or moving in from another area and their property taxes are huge because they're buying the homes at a higher value now and it's taxed at the value now. And yeah, I think that's going to benefit a lot of people,
That's
especially
great.
here in California. The next one, and this is the caveat where this change applies from 2026 onwards. So for the 2025 year, it's going to be the same, but they're starting to increase the child tax credit. So right now, for any child that you have that's under 17, your tax credit's $2,000, and it's just a flat 2,000. And that is it. There is an income threshold for that, and I want to say for a married couple, once your income is getting north of 400,000, then that just goes away complete or gets reduced and then goes away completely. Those numbers still stay about the same, but the new child tax credit starting in 2026 is going to be $2,200. So that did go up a little bit, and that's indexed for inflation for the next up until 2028. Actually, no, excuse me. That's indexed for inflation and it's extended permanently. So that's supposed to be going up every year rather than just staying the same $2,000 for indefinitely. Which is kind of nice. It's kind of nice to have some of these provisions indexed for inflation because I'll see some write-offs or deductions that have been the same for 15 years, and obviously the costs of certain things are a lot more than what it was 15 years ago. So it is nice to see that.
Well, and two, I don't think we mentioned on the salt deduction that's good for how many years? Was it to 2030?
That's good to until 2030.
Okay, so we get a couple years of this increased salt deduction, and then it goes back to 10,000.
Correct. Yeah. Unless
Okay.
unless they extend it or whatnot, but
Okay.
yeah, that's
So,
only good until 2030. Yeah.
so enjoy it while it's here.
Exactly. Yeah. So that's the new child tax credit. Just kind of it goes up a little bit and then it's indexed for inflation. The next one, and this is going to be a big one for seniors and for retirees. So when they were starting to tout this bill, or even before when they were talking about doing changes, more specifically, Trump talked about not taxing Social Security at all. So what that means in the past was if you were retired, if you had a pension, or if you're still working, let's just say, and you were collecting Social Security, dependent on what your total income was, either none of your Social Security would be taxed or up to 85% of it would be taxed. So it's kind of a sliding scale. The higher your income is, then the higher that threshold could be. And then likewise, if your income's much less, then none of the Social Security benefits would be taxable. So rather than having all of it not be taxable at all, regardless of income, they've created an additional deduction for seniors. And this is going to be anyone over 65 or 65 and older. And that's essentially a flat $6,000 deduction per person. So if you're a married couple filing jointly and you're both over 65, in addition to you itemizing or taking the standard deduction, you're going to get an additional $12,000 deduction. And hopefully that can combat some of the taxable Social Security.
I know that's a big one for people because we had so many clients and people really excited about no tax on Social Security. And I tried to talk to people and bring them down a little bit from that because I personally didn't think that they were going to be able to do no tax on Social Security just
Yeah.
because I think I said this in another video. At the end of the day, the government spends a lot of money and they need tax revenue from different places. So I didn't think that was really going to work out. I am glad to see that they're going to get a little bit of an increase on that standard, which ultimately will get them a little bit of extra money back, or off their taxes, so to speak.
Yeah, yeah, it's a good compromise. The clients that receive a lot of Social Security, like I was just looking at one that combined husband and wife receive about 75,000 in Social Security, which is a lot.
Yeah.
And currently about 50,000 is taxed. So if they made that not taxable at all, then the government's losing out on 50,000 of additional income they can tax. Whereas if they can just give them a 12,000 deduction, well, at least they still get to tax a good portion of what was taxable. So
Well, and people can remember too, there's no change on the state side. Social Security is not taxable, at least here in California, or in many states it's not taxable. So they're not gonna have to pay state tax on it.
right, yeah. The next change, this was a little bit of an interesting one. So well, number one, in the past we had a tax credit for buying an electric car, and that's changed throughout the years. Way back, it was dependent on how many cars that manufacturer sold, and once they hit that limit, then the credit was gone completely. So Teslas were gone. The credit for the Teslas initially was gone early on because so many people were buying Teslas, but the car could be made anywhere. Essentially, it had to be brand new. And then a couple of years back, they changed that, and so essentially the car had to be U.S. made, and the credit was going to go on. I don't want to say indefinitely, but it was supposed to go on for much longer. What they've done in the bill is they've stopped that credit. So for 2025, if you wanted to get a new electric car, let's just say a new Tesla, and it's below the price limits, and you qualify for it with your income, you have until September 30th to buy it and either take the tax credit on your return or take it off of the sales price. So after September 30th, that's gone completely. And also, a lot of people would be buying like charging stations for their house, and that would qualify for essentially the solar credit, or the electric credit. That's going to go away by June of next year. So taxpayers have at least almost one more year to be able to buy home chargers and get a tax credit for that.
Okay.
But the interesting thing is for any new vehicle that the final assembly was here in the U.S., you can deduct up to 10,000 of car interest payments on your return. Now, we don't really have clarification on the specifics of this. I don't know if it's going to be just a separate deduction or if that's going to be included with your Schedule A itemizing. So we just have to wait from the IRS to get guidance on that. But essentially, if you buy a new U.S. made car and you pay interest on that, you can deduct that up to 10,000. And I believe there's an income threshold for that, and I think that's capped at 100,000. So if you make more than 100,000, you won't be able to take that as a deduction. If you make less, then you can.
Hopefully, you don't make less than 100,000 and have $10,000 of car interest.
I know. It's also it's not a hard stop at 100,000. It gets phased away. And again, we just have to wait for the IRS to clarify what that income threshold is. But to write off 100% of that, your income would have to be less than 100,000.
Okay.
That could benefit seniors too, especially if they have, Social Security, where not all of it's going to be taxed. If they have brokerage accounts that they're living off of, and they don't really have that much of a taxable income, so I could see that benefiting them. The other two ones, and I don't really know how they're going to do this, to be honest. Again, we need to wait for the IRS to issue guidance. But for anyone that's a worker that gets tips, so whether you work in the service industry or mainly in the service industry, and you're getting tips, you're able to deduct up to 25,000 of tips from your taxable income. And this only applies to federal taxes, not to any state taxes. You'd have to wait and see if any states are going to comply with that, which I don't really believe that will happen. And then I believe that's that's capped at if your income is 150,000.
I wonder how much of a change the IRS will see in that, because I don't know how many people are actually reporting their cash tips anyways. So we'll see how that changes. But
Right. Yeah, we'll see how that goes. The other one's going to be more interesting. So this is going to be no tax on overtime. That was another one that
yeah,
Trump had promised, throughout the campaign trail. And so this adds a no tax on overtime, and it's a deduction capped at 12,500 or 25,000 for a married couple. And essentially anyone making 150,000 or less will qualify for the maximum deduction. I
this
don't know
is
how that's going to be played into effect, but we'll see.
that's probably the most interesting one, I think, that they were able to get through.
Yeah.
People, like, if you do work overtime, when you get that check and you're like, oh man, where did it all went to taxes, practically like 50% of
Right.
it went to taxes.
Yeah.
So I am surprised that they got that through. Definitely people who are working overtime, who are not salary type of employees, will benefit from that up to that income limit.
Right. Yeah. So
The,
we'll see.
the
It's not
one
going to be
thing,
exempt from any payroll taxes like Medicare,
right.
Social Security, but if it saves them a good percentage of federal taxes, that's pretty nice.
I think the one challenging thing with all these changes is it seems like there's a lot of different dates and phase out, income limits and all these things to kind of keep track of. So, Jay, your job as a tax preparer and informing your clients might be a little difficult for these next 1 to 2 years as we kind of make this adjustment.
Yeah. That's why we're here.
Yeah. Well, and you'll get the hang of it quick, and get the guidance, as this becomes more in effect over the next coming months before next tax season. But
Yeah. Yeah.
um, well, great. Well, thanks for going over all those details on how big and how beautiful all the changes were. Some were bigger and more beautiful than others, but I think overall, a lot of people will most likely see a benefit to that. So we hope that you found some value in this video. If you did, please like, subscribe. We look forward to seeing you in the next video. Take care.